Well, welcome to the Snowbirds Expat Radio Podcast. I'm your host, Gerry Scott. Today's episode, we're going to be talking about U.S. and Canadian tax issues impacting Canadians buying U.S. real estate. And we have a three-time returning guest today. We have Steve Flynn from Anderson. Now, we know everything about Steve, so we're going to hear more about his firm. He can fill us in and what they specialize in, and then we're going to jump into some great questions. And before we came online, we were talking about the impact of the speculation tax and the vacancy tax, and is that causing more people to look at United States to buy property now that BC is getting very expensive. So, Steve, third timer, that's a pretty big deal for Snowbird US Day Tracker.
Is there a jacket I get to wear as being part of the third timers club? Is there a special VIP room I get to sit in?
You know, if it was a jacket, it'd be a loaner. Okay, this is a small operation.
That's fair. That's fair. So, hey, great to be on the podcast, Gerry. I always look forward to talking to you about some unique tax issues. You talked about vacancy tax and speculation taxes, and this is something that's been around in British Columbia for a while. You start to see other jurisdictions in North America start to introduce these. You see it in pockets in Toronto and Ottawa and Hamilton areas that they start to debate it. It's in San Francisco, it's in Oakland. People are starting to, around the world, pay attention to what Vancouver and British Columbia are doing. Does it drive behavior? I don't anecdotally know, but I would say this: if a family's looking to buy a second property, and if they look at Vancouver, Victoria, if they look at other, places in British Columbia, as the province expands, seems like every year their coverage, and all of a sudden you're paying 0.5% on the assessed value. Places like Washington State, places like California, Hawaii, Arizona, other places look much more attractive. And I don't doubt that helps dictate how people spend that kind of capital on a second home.
Well, we'll have to, we talk about doing webinars and how we can make it affordable for, not so much affordable when you're trying to buy a second home in some of these great golf destinations, maybe San Diego, Maui, or whatever the case is. But we definitely have to do a podcast on getting people a little bit more excited about where they can buy a second property.
Absolutely.
So here we are. Here, I'm going to jump right into the first question we have, which is U.S. Canadian tax issues impacting Canadians buying U.S. real property. We covered this topic last fall with Deborah Kellicott, and you really wanted to kind of follow up on a part two. So tell us more.
Well, I listened to Deborah's podcast. I think she did a really good job covering some of the U.S. tax issues associated with Canadians buying U.S. real property. And those are everything from the income tax implications if you rent it out and earn rental income. More importantly, the estate or the death tax implications of a Canadian buying U.S. real property. It's not a concept we think of in Canada because we have a different concept when it comes to taxes when someone passes away. In the U.S. is very different. I think she did a really good job covering that. I encourage people to listen to that podcast to kind of go through that depth. I won't rehash what she said, but one of the things she mentioned is, she's based in the U.S. She's not a Canadian tax practitioner. There's Canadian issues and planning opportunities and pitfalls to watch out for when a Canadian family buys U.S. real property. And that's what I thought would be kind of a good conversation today. I'm going to call it kind of part two, building on what Deborah's already talked about.
Well, it is very interesting, and like I say, I mean, Deborah has that U.S. perspective, but then of course we get Steve, and Steve, you have both sides. Not only you're filing U.S. tax returns, you're filing Canadian tax returns for people. So what's the biggest concern, and what's the first thing? Where do you want to start?
Well, we get asked this question often as Canadians that are either they've identified a property or they're starting to look to say, we either want to buy a home in the U.S. and how do we do it? And the answer to that question depends on a lot of different factors. It depends on everything from, why are you buying this property? Is it a rental property? Is it a commercial use? Is it your own personal use? Is it for the family? Is it a mix? Are you going to use it a couple weeks out of the year and rent it out? And so those are the first things we ask. I also want to know, how much is the property looking for? What's the value? How much are you going to put into the property? Another big question we ask is, what is your net worth? And we want to know that because there's an estate tax or death tax calculation in the US that it doesn't tax your worldwide estate if you pass away owning property, but that amount of your worldwide net worth comes into the factor of how much you might be exposed to. I also want to understand, is it a short-term purchase? Is it a long-term? Is it something you're going to sell in 10 years before you pass away? Is this something you want the kids and the grandkids to inherit? I also want to know where the capital is coming from. Or is it all finance? Is it going to come from your holding company? Is it something you have personally? All these variables then go into saying, how should we best purchase this property? And what are the things that we're thinking when we buy, and what are the things that we were looking for when you operate, and then as we exit the property, what are the things we're thinking about there? So those are the kinds of questions we want to know about.
Now, do you find that a lot of the money is coming from holding companies? Is that where a majority of the Canadians' wealth is when they're looking down south?
It varies. I mean, a lot of people have had a business. They've had their own private company for years. They've made money in it. They've left that money in the company because it was taxed at a low rate. They haven't taken the money out and they want to use that capital. And, that's fine. The challenge there sometimes is that may, take away some of the options on how best to hold U.S. real property if the money's coming from a corporation. On the other hand, a lot of people will have either money held personally, or they've got ways to take money out of the corporation on an efficient basis. Maybe they've got a shareholder loan or a capital dividend account or something. They can get the money out of the company on a fairly efficient basis. You have more choices and more strategies if you can buy it personally versus through a corporation. But it's not fatal, if you will, if the capital has to come from a corporation. There's ways to handle that.
Now, do you find that people make that first step? They're trying to be fairly reasonable, and the home they really want to buy. I almost use this like when you buy a boat, you always get that 2-foot-itis. And the first boat you buy is the 24-footer, and boy, the first or second trip, you're now looking at the 40-footer. Do you see Canadians making that mistake by buying the first home and realizing that they're having so much fun down in Arizona? Now they want they bought the apartment, but now they want the standalone. Do you see that and problems arise?
Well, we definitely do. We see people being able to upgrade and, good fortune to do that. You kind of referred to it as a mistake. I don't know that everyone would look at it that way. I think it would be, this is what we can afford now. And then 10 years now, we can get something different. And so, we're either selling our first home and buying our second home, or, we're going to hold on to the first home and buy that second home and have both. One of the things that is gets confusing for people that go through that transition where they say, okay, I have a home in the US, I want to sell it, and I want to buy another one. And they talk to their advisors in the US, they talk to their neighbors, they talk to some lawyers or accountants they know, and they give them a US answer that says, oh, well, if you buy it within 6 months, you can defer the gain. And what a great idea. So you've got this property you bought 10 years ago, it's doubled in value, and you say, well, as long as I can replace it in 6 months, then I can defer the gain until much later. And while that's true under US tax law, it's not true under Canadian tax law. And what you find is if you choose to do that, you're going to mistime the gains. You're going to defer your US tax, fine, but you're going to pay Canadian tax right away. And the problem you then have is if you pay Canadian tax right away, but don't pay Canadian US tax until say 10 or 15 years later when you sell the second property, well, now you've paid tax twice in the same gain, because you can't use the tax you paid 15 years from now to offset the Canadian tax payable this year. Anytime you have a situation where you're taxed in two countries, you want to make sure that you're timing the gain, you're timing the recognition in the same year, so that if you pay tax in one country, you can get what's called a foreign tax credit or an offset in the other country, so that you're not paying tax twice on the same gain. So in general terms for Canadians, and you'll hear the phrase 1031 exchange, we generally say that's not a good idea.
Yeah, it's interesting because that came up a few times. And not only you're dealing with the 1031 and trapping that gain on the US side that you've already paid, but then you're also having that 15% held back as well too. But I guess the 1031 kind of excuses that, but it doesn't work for Canadians.
It generally doesn't. In rare circumstances, it can for developers or people that have the right structure. It can work, but for most Canadians that are just trying to buy a second home, buy a vacation home, buy a single rental property, that structure, there isn't a structure that's going to help them defer the gain. You're just better off to pay the tax, bite the bullet, if you will, and then buy the second property and move forward.
It's interesting because if you spend a lot of time in Arizona, now the place that you enjoy is Arizona, or is it in Palm Springs?
I was lucky enough. My parents had a place in Scottsdale, so we went for probably 30 years to Scottsdale, to the Phoenix area. My wife and I have gone to Palm Springs the last couple of years and just love it there. So I love both.
What's interesting is when I talk to all these realtors that cater to Canadians, they don't they cater, but they still don't ask the right questions. And we had a realtor he's a good guy. But sadly, what they were talking about this 1031 is, oh, this is a great strategy and take advantage of it. We have a client who has a beautiful home and they were considering moving. But once again, I don't think they don't ask the right questions. No one really does specialize in this unless you're
Well,
finding something different.
well, no, I think we do see that, and I think it's people give U.S. answers based on what U.S. law says, but they don't take into account the Canadian tax considerations. I think Deborah did a really good job of saying, "Hey, I'm not a Canadian tax professional. You need to get that advice." The advantage I think for people in my field, like at Anderson LLP, that specializes in Canadian U.S. tax, is that we know the tax in both jurisdictions. We can take into account the U.S. issues and marry and strategize and pull them into what happens in Canada. One of the biggest questions I get is a family's looking to buy a property. They say, well, how do I own it? How do I hold it? And I think, I talked about all those variables we ask, and I'd say, there's never one foolproof way to do it. There's about a dozen different ways you can do it. And I say the very first thing we do is we try and explore, what is that family's exposure to U.S. federal estate tax or death tax, on the assumption that they're going to hold the property long term. They may pass away owning it. Maybe it's something they want to have for the kids, the grandkids. What's their exposure? And so, as a general term, if a family's net worth is less than 15 million US, and that's, I'm going to say a married couple, each of them with net worth of about 7.5 million US. If their net worth is less than that and it doesn't look like it's going to increase anymore, those are the estate tax limits that are likely to be in play starting in 2026. Right now, they're much higher. The estate tax limit under US law is about 14 million per person. That's going to expire in about 2 years. So you want to look forward and say, what's the new rate going to be? It could be 7, could be 7.5. It depends on inflation, depends on a lot of things. But that's your kind of bare minimum. If your net worth's less than that, then you could have a $2 million property. You wouldn't be exposed to estate tax as a Canadian. Therefore, all the structures we might use to try and avoid estate tax probably aren't necessary. And it might be just own it individually, own it jointly, own it in joint tenancy, keep it simple, keep it straightforward. And oftentimes that works well. We've had other situations where people's net worth will be more than $15 million, and now they have some exposure to estate tax, but they're only buying a $400,000 condo, which isn't going to go up in value. And I say, okay, well, we could put in a structure in place to kind of beat the estate tax, but if the estate tax is only, I'm going to say only, but if it's $150,000, let's say, on a $400,000 condo, and your net worth is $20 million, you got to make that choice. Do I want to spend a bunch of time and effort to make it really complex to save $150,000, or am I prepared to either pay that tax when I pass away, or if I sell the property before I pass away, then I wouldn't be subject to estate tax. So I think, you want to look at simplicity, simply because, when you then operate the property, it's under your own name. When you sell it, it's under your own name. That's the first thing I do, is kind of go through that basis.
It's interesting because some of the families we talked to over here in Maui, they're saying that the kids don't want the property. It's too far, and maybe lives have changed. Now you've got 3 kids and they're all playing soccer and taking, like the only real opportunity you get is during spring break. And these older families are telling us the kids don't want it. They just want the money.
Yep.
And
well,
they inherited the
yeah.
assets. Yeah, they inherited the assets from their family, their parents.
Right. Yeah, and we'll talk a bit about kind of some of the strategies to avoid U.S. estate or death tax later on. One of the things then, as we go through this and we ask the question, okay, well, what are those big variables? So if a family is a high net worth family, defined as, let's say, $20 million US total or more. And let's say the property is worth a couple $1 million, and now your estate tax exposure might be, again, the estate tax rate is 40%. It's kind of a sliding rate, starts at 18, goes to 40%, and it's on the value of your US assets. And so, in this case, we're talking about US real property, that's considered a US situs asset. So take a $2 million property times 40%. Let's say it's $750,000, $800,000 of estate tax. Well, now you might want to do something about that, because that might be something that you say, okay, well, I don't want the U.S. government to get that money. I want my kids to get it. I want charity to get it. You got all those different choices. So now you look at saying, okay, well, how should I hold this property to try and avoid that estate tax? And there's a couple ways for Canadians to do that. One would be to set up what's called a limited partnership. And the idea is you set up a limited partnership formed in the province you live in that buys the property. And if the property is never used for rental activity or business activity, then if you passed away, the argument under US law would be that you don't own an interest in US real property that would be subject to estate tax. The argument is that you own what's called an intangible asset, or an interest in a partnership that's formed in Canada and wouldn't be a US situs asset and wouldn't be subject to estate tax. So that's one argument. It is not a foolproof argument. It's based on case law. It contradicts what the IRS has often tried to conclude, that you'd still would be subject to the estate tax rules. So it's not foolproof, but it gives you an argument to avoid estate tax. There are ways to protect that even further, and there's some special elections you can make under US law that effectively can take that partnership and treat it as a corporation, again giving you another protection for estate tax. And so there's ways to do it. There's a whole bunch of nuances about how you form it. It's got to have a business purpose, filing tax returns in Canada, business use, check the box. There's a bunch of things that we can talk about maybe in part 4 of this, or my 4th appearance on this. But that's one way to do it. There are other ways to do it. Some families will use a trust. They'll have a Canadian trust hold the property, and it'll be a trust that's effectively an irrevocable trust, meaning the contributors to the property don't have the influence over it. They're not trustees, they're not beneficiaries. So that's another way to avoid estate tax. Trusts have some benefits. They also have some problems in that you're supposed to lose control of the property if you want to try and avoid estate tax. Trusts in Canada every 21 years have to have a deemed disposition of their assets. So they have some limitations as well. Others will use corporations. They'll use Canadian corporations to hold the property. And you asked me the question before about, well, what if the capital's in the corporation? Well, you can use a corporation to hold the property. That's going to protect you from estate tax, because if you pass away, you don't own a direct interest in US real property. You own shares in a Canadian corporation, so you wouldn't be subject to estate tax. The downside is a couple. One is when you go to sell the property, you're going to pay US tax on the sale, and then you get into this refundable tax mechanism in Canada with capital gains, refundable tax. And when you go through the calculations, your capital gains tax between the two countries is higher than if you just held it directly or through a partnership or through a trust. And so that's one problem. The other one is that as a shareholder, if you're using a corporate entity to buy property, if you're using it personally, you probably have a shareholder benefit, which means you get a taxable benefit on the value of the property that you use personally. And so, that can become an inefficient way to use personal property, because you get a tax benefit on the days you earn personally. And there's some ways to get to manage that, but those ways often involve you putting more money into the company that makes you pay tax later. So, corporations aren't a great way to invest when there's better choices.
It's interesting when you buy, I just had a couple of thoughts here. When Canadians do buy these investment properties, and how they hold them, they kind of look for a local accountant over here in Maui and say, help me with my Canadian tax returns or my US returns, etc. You would have to believe that if the relationship between yourself and that Canadian client when they hold a US asset is so important, not just for today, but also any kind of planning that they're going to use down the road as well. And, I always tell people this podcast, and I mentioned in the last podcast, this is not a do-it-yourself podcast. We're not trying to educate people. Here, you talk to Steve, and he's now showed you how to do it. This podcast is about getting these people in touch with the right people like yourself. And please do not try this at home because boy, it's complicated stuff. Now, here's a question that I get asked all the time. You get 15% withheld when you sell your property. Why do they withhold the money? And how soon can you get that money back? So let's say on a $4 million home, you're looking at $600,000, roughly.
Absolutely. So this is called the Foreign Investment in Real Property Tax Act, and this is called FIRPTA for short. And this is the U.S. federal government's way to make sure that non-U.S. persons, when they sell U.S. real property, pay tax. Because the Congress and the Internal Revenue Service know that they'll have a difficult time to pursue a non-U.S. person to file a tax return and to pay tax if they don't live in the U.S. They got to go through tax treaties and agreements. They got to chase people around the world. They would rather make it really the onus is on the buyer to say, buyer, you have to ask the question, are they a U.S. person? And if they say no, then you go through kind of the rules. And if it's an expensive property, 15% of the gross proceeds get held back at closing and they get sent to the IRS on behalf of the seller. And generally, 15% of the gross proceeds is usually much higher than the actual tax on the gain, because the tax payable on the gain, if it's held longer than a year, the maximum rate's 20%. But that 20% is calculated on the net gain after you take into account your purchase price and your capital improvements and your commissions to sell. So the 15% of the gross is often much higher, hundreds of thousands of dollars higher than 20% of the net gain.
Now, is there a time restriction that you have to apply for that money, or they're going to say, forget it? Is it a 12 months?
Yeah, there is. Under U.S. law, you have 3 years from the date of the return to file for a refund. And so if you have a 2024 sale, and again, if you're a non-U.S. person, your tax return would be due June 15th, 2025. So it's due the next year. So you'd have 3 years from that date to file for a refund. Anything after 3 years, the IRS isn't required to pay it, and you're probably stuck leaving the money with the IRS. What we find with a lot of our clients going through this process is it's cumbersome, it's clunky, it's manual, and it can take months, if not years, to get that refund out of the IRS. And some of the reasons for that is a couple. One is that they don't have any identifying number with the IRS, so you've got to go through and get that. And just as important too, oftentimes the escrow documents on closing don't agree with what should have been held, what the taxpayer's name is, that things weren't filed properly. And so, I've got a couple different solutions we can talk about on that, but people have to be aware that process, if it's not done properly, can take years to get your money back and can be a very frustrating process and tie up your capital for a great length of time.
I think Deborah mentioned that a person should have a TIN right away, to have some kind of identification so that it would help the process on the sale of the property.
Absolutely. So that's my first tip here is you do not have to have an individual taxpayer identification number when you sell property. You don't have to have one. You can apply for it later. And the application process is one that requires some work and some effort and coordination either with a U.S. notary or something called an IRS certifying acceptance agent. The idea here is that the IRS is not going to just give you a taxpayer number because you asked for it. You've got to certify who you are. You got to provide documentation as to who you are. You have to have someone certify and review the documentation. So for example, Anderson is a certifying acceptance agent. So what we can do is we can look at your passport and your Canadian passport, verify that and say, this is who you are. And we can then certify to the IRS that says that we looked at this original document and this person is who they say they are. And we can get that number. Now, in general terms, the IRS doesn't issue these numbers until you file a tax return. There are 4 or 5 or 6 exceptions to filing for those. And what happens often is people don't get their numbers until they actually sell the property because they never rented it out. They've never worked in the US. They didn't have a social security number, so they've never had it. And that's what causes the long delay. What we often recommend is as you buy property, and you know you're going to sell it someday, if there's any way for you to get a US number before you sell, it's going to greatly improve the efficiencies when you sell. So then the question is, well, how do you do it? Well, there's a couple ways to do it. One is you got to generally have a tax return to file or a form to file. So it could be anything from perhaps you've got an investment in a limited partnership in the US that's got US trade or business that issues a Schedule K1. And you know what? You've got to file a tax return. And it may not be a complicated tax return, but if you have to file, then that's a point where we can apply for that number for you and you can get it issued. Maybe you've got rental income and we can file a tax return and do that. Maybe you spend more than 120 days in the US and you kind of go through your formula and say, you know what, I spend enough time in the US, I meet what's called the substantial presence test, and I got to file this Snowbird form, this closer connection statement, they call it. And you know what? You can probably obtain a number that way too if you have a requirement to file. So by getting a number in advance, you've kind of, I think, fulfilled step one, which is when I go to sell and the escrow agent asks for my details, I can give them everything and I can give them a US number. Because the key then is on the escrow documents, including the tax slips that go to the IRS, if your 9-digit identification number is on those documents, that's going to greatly improve the IRS's efficiency to say, okay, we got $100,000 of FERPA withholding. It belongs to this 9-digit number. We're going to stick it in that account and we'll be fine. Because if you don't have that number, then the IRS goes through the process where they give you kind of a 30-digit tracking number. They're supposed to send you a letter 6 months later. You got to submit a lot more documents. And then somehow the group that puts all these returns together, I think it's in Ogden, Utah, they got to kind of match everything up manually. And that takes months and months and months.
So let's use this this $4 million home. It's owned.
Yep.
It's owned personally. A person gets 15% withheld, which is $600,000.
Mm-hmm.
What can they expect? What can they expect in the form of taxes? Is there capital gains tax being owed to America? Because we're in the United States, the IRS. Because what I'm thinking is that, let's say, for example, you don't get your refund back. You've got this capital gains that maybe you've paid tax on, but then you get to use that foreign tax credit to offset any taxes. So do you have to go back and amend your Canadian tax returns as well?
Well, what you do, and you'll use your examples. Let's say you got a $4 million sale, and just for sake of argument, let's say you spent $2 million to buy the property. So you spent $2 million, you sold it for $4 million, you got some commissions, you got some capital expenses. Let's say your gain on that property is $1.9 million, if you follow me so far. So now that $1.9 million gain is taxable in the US. You'll pay a 20% tax, let's say. So it's $380,000 of tax. That gain's taxable in Canada as well, because again, you're a Canadian resident. As a Canadian resident, your worldwide activity is subject to Canadian tax. And so you take the $2 million you spent plus the costs, you take the $4 million you received, you translate it into Canadian dollars at the time those things occurred. And then you got a Canadian tax, you got a gain for Canadian tax purposes in Canadian dollars. The US tax you paid, the liability itself, the 20% times the 1.9 million gain, the $380,000, that can be claimed as a foreign tax credit on your Canadian tax return, so that if let's say you had $500,000 of Canadian tax on the gain, you take off the 380, you're only paying 120. You're not paying tax twice on the same gain. You're using whatever you paid in the US and you're counting it as a credit in Canada.
Okay.
But as you can hear in the numbers, and I know there's a lot of numbers there, when you sold the property for $4 million, 15% or $600,000 got sent to the IRS through the escrow agent. It got, held at the IRS. Your actual tax liability is only 380, so you've overpaid by $220,000. That's the refund we want to get for people as soon as we can. And I got a couple of ideas how we could speed that up, but that's the importance of being prepared when you sell to accelerate that refund.
You know, you never ever hear people talking about and I mentioned this a few times on today's podcast. You don't hear people really maintaining that relationship with a person like yourself. They buy the property. They probably don't even come to you. I think a lot of times people come to accountants once they have a problem. And then,
Sure.
of course, that gets expensive. But so I guess really the biggest thing is make sure you're maintaining that relationship. If you own that property in the United States, make sure you have a relationship with Stephen Flynn.
Well, no, I appreciate that. I mean, I'll tell you why that's important in my example here. So we talked about there's kind of three things I look at if people want to accelerate the refund, at least get it as quickly as they can. I think there's three things they do. The first one I talked about is find a reason to get your individual taxpayer number before you sell. And you got to file a tax return, like find those reasons. And I can talk to you about ways you would do that that are, appropriate, legitimate. The second would be when you're closing, make sure you use an escrow agent that knows what they're doing when it comes to FIRPTA. I say that because escrow agents are high volume, low margin transactions. They put through a ton of activity. And these non-routine or outlier transactions, when you have FIRPTA, are difficult to process because they don't see them very often. They don't see the forms very often. And so unless you have an escrow agent that knows what this means and knows the importance, inevitably they may get the forms wrong. And it may not be till months after closing, and I've seen this happen before, where I start to look at the escrow forms and say, oh, you didn't get this right. It's the wrong number. It's the wrong account number. It's the wrong address, like whatever it is. And this is going to create the delays. And so what I encourage people to do is to spend the time and the effort at closing, get your accountant involved. I look at all these escrow agent forms. I get introduced to the escrow agent. And I go through the fine tooth comb to say, okay, in a couple months from now, when we're preparing your tax returns, I got to be able to take these documents and know they're going to work. So I want to see those escrow agent forms. And for the most part, I think escrow agents appreciate the advice. They want to get it right too. And you don't have a lot of time between an offer accepted and closing, but that's an important step to make sure that gets right, because most sellers wouldn't have a clue what these forms mean. But that's an important step to go through.
Okay. Here's another thing that we see. People buy these homes, inflation, taxes have risen, cost, HOV, all the association fees. And then they start to sign these. Well, I'm going to rent it out. I've got a 6-month lease or a 1-year lease. The kids are going to be playing a lot of sports. We're not going to go back for another 2 years, 1 or 2 years. That is also a problem as well. As soon as you sign a lease and change the use on that property.
Well, it can be. I mean, there's a couple different factors on that, and Deborah spoke to this on a U.S. tax perspective, that income could be considered taxable in the U.S. It generally is, because it's income from U.S. real property, and so a couple different ways to handle the taxation. The most common way people do is they elect to file tax returns, they elect to deduct their expenses, they can depreciate the property. Also taxable in Canada as well, same requirements. There's some Canadian rules that can apply if you had the property for personal use, and then you changed it to business use. That could be a deemed disposition for Canadian tax purposes. So there's elections you can make to avoid that. And so anytime you go through that change, you got to consider the U.S. piece and the Canadian piece at the same time. That's right.
The more and more that we keep on talking about all these things that can go wrong, we can't stress enough that you have to make sure that you're communicating with your tax professionals on this situation. Steve, anything else you want to add before you? I know this is a busy time of the year for you.
Sure.
Anything else you want to add before we let you
go?
It's
just on that theme of how do you make sure you get the FIRPTA withholding applied and get your refund as quickly as possible. I kind of mentioned the two pieces. One, which was get your ITIN number in advance. Two is at closing, get those escrow agent property, get the escrow agent to make sure the documents are prepared properly. I think the third one is work with a firm that can electronically file your tax return. That's available for Canadians that file non-resident U.S. returns. When all those steps get done properly, I had a client last year where we were able to kind of plan this over 3 or 4 years, and we got them their numbers. We worked with the escrow agent, and when it came time to file the returns. We had everything lined up, everything in order, everything matched. We electronically filed the returns, and the hundreds of thousands of refunds got paid directly to their bank account through an e-transfer, probably within a month, which is about the quickest I've seen a FERPA refund get paid. And what a terrific answer. I mean, we avoided all the different delays, and they got their capital back very quickly on that. But it takes some planning, it takes some process to do that. And maybe it's not important on a $20,000 timeshare that you've held for 15 years because the dollars aren't big, but when it's a couple $1 million home, that's a lot of capital tied up and could be tied up for a while. So,
Well, I'll share with you some of the changes we've made on the Snowbird US Day Tracker app. We've got this technology now that the podcast has always been great to introduce people to the partners we work with, but now we've got this new feature that we will be doing webinars, and we'll be able to. And one of the first webinars that we want to do, there's 4 of them that we're planning around. And Steve, I want to get you involved on the real estate side. Is it really does allow people to participate in these webinars. You'll get notifications through the apps. We expect to do maybe every quarter we'll do a topic, a webinar. It's all going to be done through Zoom webinars, and Steve, you'll have to get your great presentation ready, and I hope we can do this over the next 6 months. But I just can't, especially because I do spend a lot of time in Maui, and I see all these Canadians and all the things they're doing. And we're getting asked more and more questions based on, the kids don't want the place and they just want the money. So these webinars are going to be very important. There will be a notification that comes out through the app. We promise there won't be a lot of notifications. When we do a podcast, there'll be a notification. Hey, listen to today's podcast with Steve Flynn. And then we'll notify you that there's a webinar coming up and you can register. So that is what we've worked on the last 6 months. It's available. It's going to be released today, and we'll do a lot of marketing around it so we can get those seminars with people like yourself, educating these clients and pointing them in the right direction to make sure they're getting the proper advice. On that note,
that sounds great. Yeah, I'm always happy to help on that, and just great to get that education out to people.
Yeah. So thank you very much for your time today, and I truly appreciate. And I end every podcast with the world is small, be kind to all. So it's so important in today's world. So thanks again for your time.
Thank you, Gerry. Appreciate it.
Okay, take care.